Pivot point or swing point. Correctly identifying pivot points is the first and most important step in forming market structure, identifying POI zones, and ultimately entering a trade. It all starts right here. Even a small mistake in identifying pivot points can make us read market structure the wrong way. If we get this first step wrong, the market structure we see will be wrong too. And after that, the entry zones won't be identified correctly either. As a result, trades end up getting taken at the wrong levels. This is exactly where the biggest misunderstanding happens among traders who use market structure. Some people think identifying pivot points means looking at a specific number of candles before and after a given point. For example, they say a pivot low is a point where the two candles before it and the two candles after it are all higher than it, and that point basically shows a low or a valley in price. Here, the two candles before this middle candle and the two candles after it are all higher than it. According to that view, this middle candle would be considered a pivot low. In the same way, a pivot high is a point where the two candles before it and the two candles after it are lower than it, and that point basically shows a high or a peak in price. For example, here the two candles before the middle candle and the two candles after it are lower than it. So based on this definition, this could also be considered a pivot high. But some people believe this method isn't all that accurate for identifying pivot points. This group says that to make it more accurate, it's not enough to just have a few candles before and after be higher or lower. The way those candles are arranged also matters. For example, here they say that because the low of the second candle is lower than the low of the first candle, we can't consider this point a pivot low. Or in this one, because the high of the second candle is higher than the high of the first candle, this can't be a pivot high either. In other words, this group says that besides the number of candles before and after, there also has to be a specific pattern in how those candles form. For example, for a pivot low, they say there should be a bearish sequence on the left side of the point, meaning before it, and a bullish sequence on the right side, meaning after it. That way, we can consider that point a pivot low. For a pivot high, they say it should be the opposite, a bullish sequence on the left side and a bearish sequence on the right. Of course, even this group doesn't agree on one fixed number for how many candles before and after should be used. Some people, for example, use just one candle on the left and one on the right instead of two. Some people use 5 candles as the criterion, and some use 10, and that's how different numbers end up being used to identify pivot points. But both of these views are flawed from the start and are completely wrong. Why? Because when we use a fixed number to identify a pivot point like 1, 2, 3, 5, or 10 candles before and after, we're introducing a completely arbitrary criterion into the analysis. And the result is that different traders end up seeing different market structures. For example, look here. The trader who says a pivot low is a candle with one candle before it and one candle after it that are both higher than it sees one kind of structure in the market. But the trader who uses that same definition with 5 candles sees a different structure in the market. And that's how each trader ends up seeing a different structure. Different highs and lows get identified, and many of them are invalid or tied to internal structures. In reality, there's only one true market structure in each time frame. And when we're looking at one time frame, everyone shouldn't be seeing their own version of market structure. On the other hand, because these models are just counting candles, inside bar candles end up getting counted too. And that causes the market's internal structures to get pulled into the analysis too. As a result, the internal structure and the main market structure get mixed together in the same time frame, and that leads to a wrong reading of the real market structure. Look at how these candles are moving and how they're placed relative to each other. The market is volatile. Do you really see this point as a pivot point? This is completely wrong. That point is not a pivot point. Almost all the indicators out there right now identify pivot points exactly like this, and that's wrong. Let's watch a short video together. In this video, we randomly picked a few of these indicators. All of these indicators ask the user for an input number to identify pivot points. In other words, the user has to decide how many candles before and after a point need to be higher or lower for that point to count as a pivot point. One enters 2, another enters 5, and another enters 10. And as a result, each one ends up seeing a different market structure. Why do all these indicators ask the user for a number and end up creating arbitrary structures? The reason is simple. The coding is complex. We spent months on it before we were finally able to implement this logic the right way. Now that we understand these arbitrary methods can't be a solid basis for identifying pivot points, what's the right way to identify them? Where exactly do pivot points form? And how can we identify them correctly? To identify pivot points correctly, we have to use the concept of pullback. The only correct way to identify pivot points is by using pullbacks. There is no other way. Pivot points form exactly at the highs and lows of pullbacks. Once we use this logic, it's no longer the case that every analyst ends up seeing a different market structure. And in a given time frame, all traders see one single market structure. Also, inside bar candles, which belong to internal structures, are not taken into account in this process. So next, let's take a look at what a pullback actually is and how it forms in the market. Pullback. A pullback is a temporary move against the trend, or a temporary price correction during a trend. The market is always moving, and price doesn't just go straight up or straight down. Along the way, it also pauses now and then. In an uptrend, a pullback is a temporary drop in price. And in a downtrend, it's a temporary move up in price. Let's say we have an uptrend and price is moving higher. In this uptrend, pullbacks show up as temporary drops in price. Right here, we have a pullback, and its lowest point is the pivot low. Then we have another pullback. This one is a complex pullback, meaning sometimes a pullback has smaller moves or pauses inside it, so it's no longer a simple pullback. We call those complex pullbacks. Further up, we have another pullback, and its lowest point is the pivot low. So overall, in this uptrend, we had 3 pullbacks. 2 were simple and 1 was complex. Now let's say the trend is down. In that case, pullbacks are temporary moves up in price. Right here, we have a temporary move up in price, and its highest point is the pivot high. Then again, we have a temporary move up in price with smaller fluctuations inside it. We call that a complex pullback, and its highest point is the pivot high. Later on, we have another temporary move up in price, and its highest point is the pivot high. So in this trend, we had 3 pullbacks. 2 were simple, and 1 was complex. Now in a market that's highly volatile and full of small moves, how do we identify pullbacks the right way? Because if we're not careful, we might mistake internal market noise for pullbacks too. How do we filter out that noise and find the real pullbacks? We'll get to that in a bit.